Good evening, guys. I hope everybody can hear me. From the Vice President of Operations at BluJax, we want to go ahead and get started as people continue to come in. I want to thank you guys for coming to our second webinar with our partners. This time we're going to be talking about taxes with David Cook, and then Stephen Davis is going to be doing a client control. So I hope you guys enjoy yourself. I want to talk to you a little bit again at the end of this. I don't want to waste your time because time is money. So I appreciate you guys coming on. I'm going to have David take over from here. He's going to introduce himself. He's one of the CPAs here at BluJax.
Perfect. Thank you, Michael. So as Michael mentioned, my name is David Cook. I'm a CPA. I've been licensed since 2018. I've been practicing since 2014. Got my bachelor's from Georgia State. And I am a dad of one, soon to be two. And today we will be talking about tax extensions. And I'm actually going to try and keep it very simple because I think this topic can be simple. So to kind of set the tone, basically, this topic gets a little this topic gets a little overcomplicated, but we're going to keep it simple by staying with kind of three rules. One, not all returns follow the same timeline. Two, filing and paying are two different things. Then extensions only solve one of those two different things. So the real divide is going to be starting off taxpayers versus pass-throughs. So this kind of creates a little bit of confusion because oftentimes this question is presented to me as, what is the difference between individuals versus businesses? Well, that doesn't associate very cleanly to the deadlines. Taxpayer versus pass-through does, and I'll explain why. So a taxpayer, from a form perspective, doesn't matter so much, but the forms that this would associate with is like a 1040, which are your individuals, 1041, which is a trust, and then 1120, which is a corporation, not an S corp. Those are your taxpayers. Those returns or those entities or individuals pay the tax. Pass-throughs, on the other hand, getting into the forms, that's your 1065, that's your 1120S, that's your S corp. Those are going to be your pass-throughs, and they generate what's called a K1. Now, the deadline when you think about taxpayer versus pass-through becomes easy at that point. Pass-throughs is going to be 3 months and 15 days past the end of the year, so March 15th. And then you have taxpayers, they're going to be 4 months and 15 days past the end of the year or the beginning of the year, however you want to look at that. And so the reason it's set up that way is because when the K1 is generated from a pass-through entity, it is thus needed for the taxpayer to appropriately calculate the tax. So that's why that deadline comes first. So that deadline is associated with filing. It's not associated with paying taxes. When it comes to paying taxes, the way the IRS really looks at that is really you should be paying taxes all throughout the tax year. So by the time you get to filing your taxes, if you're just now thinking about paying the tax, you're actually late, right? And so the extension only helps with filing. When it comes to paying, that needs to be done really throughout the year through estimated payments or through your W-2 withholdings or similar holdings such as 1099s. And that is how you pay throughout the year. Then at the end of the year, once you file, really what that is in the eyes of the IRS is you reconciling everything, right? This is what everything has been calculated as now that we're filing this with you. Oh, and by the way, we did happen to have a small discrepancy. Here's that additional payment, right? Or refund. And so that's where the deadlines come in. It's for filing. That report that you give to the IRS that says, hey, I paid the appropriate tax throughout the year, I paid too much, or I didn't pay enough. Let me give you a little bit more right now. Now, extensions, like I said, they do not give you more time to pay. They only give you more time to file the report reconciling everything from the prior year. Now, the expectation on the taxpayer is that even if you file an extension, you still need to reconcile the payment. And if you're caught paying too little, there's a penalty for that. We'll talk about that in a moment. And so that extension, for that reason, really only helps with the filing. And paying helps to stop you from getting additional cost or additional interest or penalties associated with the tax liability that wasn't paid in full throughout the tax year, right? So we're generally filing taxes for the prior year. Now, when it comes to penalties and interest, I'll just give you high level, right? Starting off, you have your failure to file, right? That means you didn't file an extension and you were late filing. They're going to give you a penalty for that. It's different depending on the type of return, taxpayer versus pass-through. Then you have a failure to pay. Pass-throughs do not worry about this. Only taxpayers worry about a failure to pay. Then you also have an underpayment penalty. And that is going back to what I was saying, the expectation is that you're paying your taxes timely throughout the year. And so they penalize you when you don't. And that's your underpayment penalty. And so each penalty, they will assess additional interest onto a penalty. They will also assess interest onto the balance of tax owed. Once that full balance is calculated, they will then continue to calculate interest on that entire balance. So that's the high level behind penalties and interest. And so pass-throughs, one note to keep in mind, when it comes to the failure to file, like I said, for failure to pay, pass-throughs don't worry about that. Therefore, the IRS puts a little bit more scrutiny on the failure to file. Failure to file penalties are significant, and it's per K1, right? So a partnership may not get a huge tax, a huge penalty. It's still pretty steep, but you can work with it. But I've seen some returns where there are 100 partners, 50 partners, 20 partners, and it adds up quick, right? So that's where even though they don't charge a penalty for not paying, because a pass-through doesn't pay a tax, they're going to hit you harder on that failure to file. Now, what to do if payment isn't possible, right? Because it happens, right? Especially if you have a 1065 or an 1120S with several partners, and you can't make a penalty payment, or the tax just happens to be very high, and you were still timely. The IRS knows this, right? They know that sometimes you just can't pay the tax all up front. So generally what you'll do for these instances is you'll actually work with them to set up a payment plan. Payment plans, 50,000 and under is generally pretty easy. You can actually do that on the online, right? With the IRS tax account, you can do those payment plans online. They give you several different options for it. If it exceeds 50,000, it's not that you can't do it. there are more rules to it, because at that point, the balance is large enough to where the lien is serious that they have to issue. And so there's additional documentation that they have to get, as well as they kind of have to get into your business a little bit. That's kind of how I say it. And what I mean by that is they have to prove that you cannot pay a certain amount, right? Because then at that point, it's not a minimal $50,000 or less balance. It's over $50,000 and they really need a commitment. So that's kind of how that works. It's just an additional form that you kind of have to sign and send in. So oftentimes you can't do that one online, but there are options for paying when payment in full is not possible. Now, the reality to that as well, sometimes even the first payment or a payment plan can't start timely. The reality to that is for about 90 days, they'll give you a bit of a grace period. That's when you start to see all of those letters. It doesn't feel like a grace period, but it's kind of like a grace period. Then really the severity of those notices start to change. And that's when you go into they call it ACS, and it's automated collection system, right? That's how you know that you're in collections at that point. And then at that point, you just work with collections to start your payment plan. So that's the reality behind if you can't pay or start a payment plan. Now, extensions extend filing, not payments. Now, one thing I do kind of want to add to this, oftentimes you'll see changes in tax law. So for instance, the One Big Beautiful Bill Act, that recently changed several thresholds that is very relevant to what I was just discussing and that answers the question of, do I need to file a return? But it does not change when the return needs to be filed or when the return needs to, when the associated tax bill needs to be paid. So that's really kind of at a high level, the tax extensions, as well as filing versus paying. So really bottom line, an extension is only solving one of those two problems. Paying needs to be done throughout the year. And like I mentioned earlier, if you are starting to think about paying along with filing, you're late, right? And now at that point, late really adds to what are the additional penalties that might be associated with that, and what is the additional interest that might be associated with that. So it really, I guess, helps to plan ahead of time before the start of the next year at least, because bottom line, if you don't make that first quarterly estimated tax payment and you get caught with the tax bill, you at least have a penalty. So with that, that really closes us out for about the tax portion, and I will go ahead and hand that over to Stephen to talk through his portion.
Okay, real quick, guys, if you guys have questions for David, I really would like you to ask him a few questions now, opposed to waiting to the end of the consulting portion of this. One question that I do have for you, David, and I think a lot of my clients and a lot of maybe even some of the consultants would like to know is, one of the things that you said was, if you don't file, right, then you're going to get a penalty, right? Even if it's a pass-through. So if it's 1120S, if I have an S Corp and I don't file that by the deadline, and I wait and I file it before I file my personal tax return, am I still subject to a penalty for filing that 1120S too late?
Great question. So yes, absolutely. 3/15 again is the deadline. Now, you do get a bit of a super small grace period of a day. If the 15th falls on a weekend, as soon as the 17th, though, rolls around, penalty. Penalty. And the penalty for instance, for an 1120S, they calculate that technically it's calculated daily. The easier calculation is monthly. So it's still pretty steep, even when you get a couple days past the deadline.
Okay. So I can file that 1120S late and I can file my personal one on time and I could receive a penalty.
Correct. Correct. And it wouldn't be for your personal, it would be specifically for the pass-through.
And would they work with me at that point in time on some type of payment plan for that? Or would they deduct that from my return if I got a return, or they tack it onto that what I owe or whatever the case may be? How would they collect that?
Great question. So the way that that's collected, oftentimes it comes through a notice, right? You can contact them to try and get ahead of that, but it just comes through a notice. You'll get a notice and it'll calculate the actual penalty.
Okay, and then they'll have a number for you to contact us and
Yes, and
contact
you
them and do it.
that one you can pay online. It's a little trickier. It's easier to just pay not logging in. So when you go to the irs.gov/payments, there is a way for you to pay directly without actually going into your account. And at that point, it's based on EIN and other associated factors. So as long as you have that information, like the if you had a prior return, what one of those numbers were, as well as the EIN, at that point you can pay it that way.
Okay. All right.